Welcome to RBC's Markets in Motion podcast, recorded September 4th, 2024. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Two big things you need to know. First, as we return from the Labor Day holiday weekend in the U.S., we find that the major challenges for U.S. equities are still lurking. We remain confident in our year-end 2024 S&P 500 price target of 5,700, but do acknowledge the challenges that must be worked through. Second, other updates from our high-frequency indicators keep us in the camp believing the U.S. economy is slowing, but isn't on the cusp of an outright downturn. Overall, we're still taking comfort in earnings and economic data. If you'd like to hear more, here's another 5 minutes. We'll start with takeaway number 1. Major challenges for U.S. equities are still lurking post-Labor Day. Back in mid-August, we observed that the pullback and rotation in U.S. equities to start that month released some of the pressures on the stock market, but didn't fully solve its major problems. Those problems we discussed included seasonality, sentiment, the U.S. election, and anticipation of the Fed's first cut. As the S&P 500 tumbled more than 2% on Tuesday, the first trading day post the Labor Day holiday, and as we were running through the latest updates to the high-frequency indicators we track each week, that commentary from mid-August was top of mind to us. On sentiment, AAII net bulls are once again flirting with levels suggesting the stock market has gotten overbought again. Weak seasonal trends in the fall have also been noted by many investors. It's particularly striking to us that September has been a down month in each of the past 4 years. The U.S. election also remains a source of uncertainty. It's also been noteworthy to us that we're entering a period when the stock market normally sees a bit of a pullback. In presidential election years, we normally see a pullback that begins early September. Investors are also nervously looking ahead to Friday's jobs report and debating whether it will justify the Fed cutting by 50 or 25 basis points. It's worth remembering that U.S. equities typically run up ahead of the first cut and also experience a pullback that begins around when the first cut occurs. Debating whether the Fed has waited too late to cut is absolutely normal, and so is the turbulence that this angst creates in financial markets. The fifth problem we'd formally add to this list of challenges is the underlying impulse in the equity market for leadership within the S&P 500 to broaden out away from mega-cap tech and AI names. After an attempt by growth and large cap to reassert dominance earlier in August, the end of August saw small caps and value make their own attempts to take back that leadership. While lingering concerns about the economy have made it difficult for the more cyclical parts of the U.S. equity market like small cap and value to firmly take the reins, the problems with the mega cap growth trade, slowing and less dominant EPS growth rates, stretched positioning, and stretched valuations are all far from solved. Let's move on to takeaway number 2. What else jumps out on our high-frequency indicators? Overall, we continue to take comfort in earnings and economic data. Sell-side EPS estimate revisions are slightly positive for the S&P 500 over the past few weeks. 55% have been higher over the past 4 weeks on our tally. Another solid data point from earnings is that the bottom-up EPS forecast for the S&P 500 for next year has actually moved up to more than 279. While most of the economic headlines on Tuesday focused on the weak and worse than expected ISM manufacturing print, which added to the economic angst in some corners of financial markets, we were surprised when we were running through our charts to see that 2024 real U.S. GDP forecasts actually moved up a little bit in late August. Like much of the economic data we've been watching, late August earnings commentary continues to paint a picture of an economy that's slowing and reacting to pressures, but isn't on the cusp of an outright downturn. General macro outlook commentary has continued to emphasize both stable and healthy trends, alongside the uncertainty associated with dynamic conditions. Negative impacts from higher rates have been highlighted, along with optimism about the positive impact of potential cuts. Consumer commentary was abundant in late August, but frankly, we didn't learn anything new. Weakness in Asia, inflation and interest rate pressures in the U.S., the implications of a stuck housing market, and lower-end weakness were highlighted by some, while others noted resilience, value consciousness, choicefulness, and an ongoing willingness to spend. Heightened geopolitical tensions and election uncertainty continued to be called out. AI discussions highlighted the early innings nature of the technology and headcount reductions made possible by its use. Though most recent AI headlines have emphasized the underwhelming nature of a certain semiconductor company's results, we found one software company's disappointment over the huge amount of money that so many of their customers have wasted on AI equally helpful to understanding why the AI theme has lost some of its sparkle. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.